welcome to Sectors Up Close. I'm Elena Casas. Today we're talking US retail and my guest is Amy Kong, CIO of Barrett Asset Management. We found out last week what Santa brought to America's retailers over the holiday season with a very mixed bunch of results. Kohl's reported a surprise quarterly loss and forecast full-year profit well below analyst estimates as steep discounts to boost sluggish demand for clothing shredded the retailer's margins. Best Buy also came in below forecasts, while Home Depot and Lowe's reported crumbling home improvement demand as the housing market stalls. But Macy's beat the street and issued strong profit guidance for the year ahead. So, as interest rates rise and inflation puts consumers under pressure, are Americans still shopping? Well, this is the S&P Consumer Discretionary Index, up about 13% this year. Of course, the biggest player here by market cap and perhaps the biggest recipient of Americans' discretionary spending is Amazon. But Home Depot, Lowe's, TJX and Target are all among the top 10 constituents. So, are shoppers becoming indifferent to inflation? Let's ask Amy Kong, CIO of Barrett Asset Management. Amy, hi. What have the results then that we've had over the last week or so from across the retail sector told us about how American consumers are behaving?
Hi, Elena. Thanks for having me. I think the consumption trends continue to happen, but certainly they're slowing down. And when we look at the retailers reporting, Q4 results were just fine, but really the street was focused on what's happening in Q1 and beyond. And just to give some context, the broader S&P 500, we saw that earnings actually have come down about 6%, but for consumer discretionary stocks, those estimates have actually come down about 9%. So to give some context, it seems that investors are expecting consumption to still chug along, but certainly that trend will slow down going into 2023.
What's the impact of inflation here? Are we seeing retailers able to pass on price increases, or are they running out of margin to do that?
It's still happening. It's the short answer. But to your point, it is also slowing down. You just can't raise prices indefinitely. And we are seeing that while some retailers have been able to raise prices 5 to 10% multiple times last year, comments from some of these management teams suggest that that rate should moderate down to maybe low single digits going into 23. So that's obviously going to put more pressure on the earnings component of some of these retailers. And we're starting to see that again with the earnings guidance that they provided this earnings season.
As Americans prepare for an economic slowdown, we're seeing quite a different picture, aren't we, at the higher end of retailer compared to those aiming at lower end consumers?
That's correct. I think the higher earning Americans, and we assume that those folks have higher level of assets, they tend to be, again, still okay in this environment. They still have excess savings from the pandemic. And I think wage inflation is still okay for that group of workers. I think the key to your point is the lower earning Americans, and we're starting to feel that crunch a little bit. Savings rate for those groups have obviously come down to historical lows as consumer sentiment continues to be very low. And when you think about mortgage rates moving higher again, plus gasoline prices out there, again, that should, unfortunately, provide a headwind for the lower Americans. And I think that continues on into the rest of the year. What we probably will see is, again, consumers will spend, but where are they spending is the top question. And I think the value component of how these retailers can, again, market to the consumers is key going into the rest of this year.
Is that the only reason why the retail picture is so mixed? Some retailers seem to be navigating this economic landscape much more easily than others, don't they?
Yeah, absolutely. That's a great question. And it kind of raises two top issues that we're seeing across most retailers. I think inventory continues to be a hot topic. Larger multi-line retailers like the Targets of the world, et cetera, while they are past peak inventory buildup, quite frankly, they still are going through, again, markdowns to try to get their inventory levels to a more baseline level. And we can see that because Target, as an example, actually reported decent numbers, but guidance from a profit margin standpoint is still quite low. And so we expect that, again, markdown will unfortunately be still at play here. And that's unfortunately one headwind hitting the retailers. The other is wage inflation. Wage inflation across the labor market continues to be about 4% plus. And we are starting to see some retailers like Home Depot, for example, increasing hourly wages. And so that unfortunately will continue to eat into profits for these players as well.
What does that mean for investors in the retail sector? Is it a case of cautious stock picking?
We believe so. We think that there continues to be some larger mega trends impacting and supporting the Amazons of the world, even though the results for Amazon as a company were not ideal for this earnings season. And then for a lot of these retailers, we're being very selective. We think that those that can, again, offer a value proposition can probably do well in a downturn potentially. And we're thinking players like the TJ Maxx's of the world that, again, have 21,000 vendors to choose from, Costco's of the world that, again, can really work to, again, have that value proposition. And even like the AutoZone of the world within the auto components market, we think those players can probably do well even if the markets were to reverse course or the economy were to reverse course.
Well, thanks so much for that analysis, Amy Kong, CIO of Barrett Asset Management. Well, that's our roundup of the US retail sector. I'm Elena Casas, and this is Reuters.